In this week's AMT Insight, I'm going to talk about China's slowing economic growth and the COVID-19 surge that we've seen across large parts of Southeast Asia over the last few weeks, and what that means for metal markets. So firstly, if we look at China's Purchasing Manager Indices data, then we can see that the manufacturing sector has generally seen a slowing pace of growth since around November 2020. Meanwhile, the rate of growth in the services sector has been a bit more volatile, but over the last 2 months, you've seen that really deteriorate too. Now, that's not really been a big surprise because we've seen over the large course of 2021 that China's been trying to tighten its monetary policy, and you see that in terms of reduced credit impulse and reduction in M2 money supply in the Chinese economy over that time period. Although now the Chinese policymakers are starting to react to the fact that this is impacting economic activity, perhaps a bit more than they would like, and they've come out and said that they were going to cut their bank's reserve requirement ratio rate by 50 basis points from the 15th of July. Now, by cutting this rate, what they're doing is allowing, according to UBS's estimates, around 1 trillion yuan, or about $150 billion of extra lending from those banks into the Chinese economy. Now, that's generally elicited quite a positive reaction from global markets, but I think that the underlying that really you have to look at the fact that the People's Bank of China has stressed that this doesn't represent a real U-turn in China's monetary policy. It's still trying to deal with these credit risks at the same time as maintaining its economic growth, and that's a difficult balance to make, really. So it may continue to use these kind of targeted tools to help the economy kind of deal with this slowdown in and this worsening of monetary conditions. But overall, it's likely to continue to exert pressure on the Chinese economy for the remainder of this year. Now, if we look at the second factor, which is the rise in COVID cases that we've seen in recent weeks, we can see that a large of this has been attributed to the Delta variant. And you've seen that the Delta variant has been spreading in lots of regions of the world, lots of countries in the world. But the concern really is on poorly vaccinated countries. And to a large extent, Southeast Asia has been hit quite hard recently. The IMF has forecast that Asia's economic growth could rise about 6 to 7.6% in 2021. But if you have countries like Indonesia and Malaysia and the Philippines and other powerhouses in Asia, places like Vietnam or like Myanmar, that are also struggling to deal with the impact of the virus, and they're having to continue these strict restrictions on their economy, then that's going to weigh on the region's economic performance. And I think the investors have reacted to that risk. You know, that there has been a reaction to these rising cases in terms of some risk-off activity and dollar support, and that's really as these investors pivot away from emerging market equities and towards things like bonds and dollars, so safe havens, to deal with this kind of heightened risk of an economic slowdown. Now, on the positive side, although some of the base metals will obviously struggle if the dollar continues to strengthen, actually nickel and tin could find some good price support from the rate of growth of cases that we're seeing in some of these key countries in Southeast Asia. So tin and nickel, more than other metals, in terms of their mine supply, they're heavily dependent on Southeast Asia, particularly the Philippines and Indonesia for mine production. But if you look at refined supply, Indonesia is also pretty important for both metals, and then Malaysia is a very important tin refiner as well in terms of Malaysia's small smelter corporation. And we've seen the impact of virus cases in Malaysia in terms of shutting down that company's production. So overall, you've got this impact on supply that's likely to be supportive, particularly to those two metals. Now, in summary, I think that China's reserve rate cuts and the spread of the variant are overwhelmingly kind of negative to base metals because, as I said, they're kind of underlining the fragility of the Asian economy and the fragility of the economic growth that's being forecast for the region, and also generating risk off, which is being put a bit of pressure on upwards pressure on the dollar as well, which also weighs on commodities quite generally. I think counterbalancing that, you obviously still have this quite strong recovery in demand and quite strong demand conditions in the EU, in Europe, and in the US, in the UK, but also these inflation concerns in terms of when the EU and the US might start tightening their monetary policy as well. So there's lots of factors at the moment, but overall, in terms of the Asia drivers, I'd say they're overwhelmingly negative at the moment, apart from nickel and tin, of course, with the supply risks that are coming from those regions.